Hey, fellow investors. Brian Stoffel and I recently hosted a 1 hour deep dive on the trade desk, ticker symbol TTD. We researched the company from scratch using our custom AI prompts and Stock Simplifier, which is the exact tool that we use to analyze a business from scratch. In this full replay, you'll see us analyze the trade desk's business and business model, understand how the company makes money, its moat, financial statements, key risks, valuation, and more. And if you watch the whole thing, you'll learn the exact process that we use to analyze any stock from the ground up. Hope you enjoy.
Yep.
What stock are we going to be researching today? Well, the answer is every Wednesday before we do these live sessions, and we plan on doing many more of these, we're going to put a poll in our newsletter asking you what stock do you want to do. And the winner this week was what?
The winner this week was the Trade Desk TTD. And just a reminder, our newsletter is free as well. So there's no charge to vote on this.
Yep. So we want to know what stocks interest you. So we'll always put a couple of stocks that are in the news. The Trade Desk, a phenomenal long-term investment. I have personally been a shareholder for many years, down on its luck recently,
Yeah, it
near a
really is.
52 week low. So I think that's why people are interested. It's been a great long-term performer at a 52 week low. So how are we going to research this stock from scratch? We're going to use the system that Stoffel and I have built together that we call Stock Simplifier. Here is the one-page cheat sheet that you get when you join Stock Simplifier. And these are all the things that we're going to use to research the trade desk from scratch. Now, we're going to go relatively fast
Yep.
through each of these. If you buy Stock Simplifier, just know that it comes with a course that has slow explanations of everything we're about to do. It has the tool that we are about to use. It has all of the AI prompts that we are about to use. So everything that we are about to do is fully in Stock Simplifier. And Stoffel, what's the first thing that we always ask when researching any stock?
It's the most important thing, and it is almost always the thing that people skip, and that is what stage in the business growth cycle is a company in?
Yep. Incredibly important to ask this question, and very few people ask this question. So here are the 6 stages of the business growth cycle. There's stage 1, 2, 3, 4, 5, and 6. You find out the stage by looking at revenue, by looking at operating income, and you look at the capital return. So let's start with our first poll here, Stoffel. Which of these 6 phases do you think that the trade desk is in right now? If we could launch a poll, and if
Yep.
you're on Zoom, if you're watching this on Zoom, go ahead and click the phase that you think the company is currently in.
If you're watching on YouTube, feel free to type in what phase you think it's in the chat. I'm checking it just so you know. But the official voting is just happening for our folks that are joining us on Zoom. So I can let you know what the folks on YouTube say as
Great.
well.
So we'll wait till we have about 59% of people have voted. This is our first one, so you guys are still getting used to how to vote. We have 60% of the votes in. Stoffel, let's cut it off there. And what did people say?
Yep. So our number one was phase 4, operating leverage. 52% of people. But we did get votes for everything from phase 2 all the way to phase 6.
Yep. So people think phase 2 to phase 6. So how do we figure out which phase that it's in? So again, we track revenue, we track operating profit, and we track capital return, dividends and or buybacks. Now in Stock Simplifier, we show you how to line up each of these metrics with a company's income statement. If you use the built-in tool, you can actually use the tool in the drop downs and it will help you figure out what phase it's in. But for this demo here, Stoffel, we're going to be using AI.
Yeah.
AI to figure this out. So here I am in Stock Simplifier, and I'm just going to open up a couple of things. So here is the spreadsheet. I'm going to make a new copy of a spreadsheet when we research a stock from scratch. So I'm going to open that up. And this is the spreadsheet tool that we use to make sure that we go through the checklist and research a company from scratch. So right here we have phase analysis, and I'm going to zoom in a little bit. That looks a little zoomed out. So here's
There
the
you go.
phase analysis, and I'm going to put in TTD. Oops, I put it in the wrong cell. TTD, and it should come up with the trade desk, a $24 billion company. Now, we teach you in the course how to use these to do it manually, but let's go ahead and open up our list of custom AI prompts. Here are our custom AI prompts, and we have one built in here for the business phase analysis. Now, you should be able to use these prompts on any LLM or
Yeah.
any.
So what do you prefer?
So I'm going to use ChatGPT just because that has the largest market share. But you can use this on Claude. You can use it on Grok. Just be warned that these prompts will produce different results depending on which one you do. They might be slightly off, which is why we have the prompts. We insist that these prompts produce their sources in there. But let's start with ChatGPT and see what AI thinks. So here's the mega prompt
So
that
all
we
you did
have.
was copy and paste. Is that right?
All they did was copy and paste here. And it's
Okay.
going to say, okay, I know what to do. What company do you want me to analyze? The Trade Desk TTD. I find it's helpful if you put the name and the ticker in there. And we're going to do it's going to do the analysis, and let's see what phase ChatGPT thinks that it's in. Okay. Searching the web. Okay, so this says using data from 10Q filed in Q1 of 2025 that was filed on this date. And there's the link to that original date. This says it's in the capital return phase, the phase 5. Now, it also gives a confidence level to say it's highly confident that it's in this stage.
So Brian, wait just for a second. That's interesting because on both YouTube and on Zoom, stage 4 was our number one answer.
Yep.
So how did it come up with stage 5?
So let's see. So here's the evidence. So first off, operating income is a positive figure.
Okay.
Okay. Number 2, revenue is growing 19%. So this is a company that's revenue is growing and it's profitable. And I think it's because of this one here. So this Trade Desk repurchased $261 million in stock in Q2 alone. And here is the filing that it pulled that up from. So the company repurchased that. So we can be very confident that this data is correct because it's actually giving us the link to the filing that it pulled from. That's a really important thing if you're going to use AI, that you insist on it gives you the original document from them. Okay, so because of that, what are the most useful valuation metrics? This says trailing price to earnings, trailing price to free cash flow, perhaps a reverse DCF, why this fits, and valuation methods to avoid. So this is where the squishiness comes in, right?
Let's talk about that for just a second, because we've got some people making comments like Roman just ran the exact same query and it came back with phase 4 medium confidence.
Yep.
And
so
then
that depends on the model that you're using. And sometimes if you rerun the same model in the same AI, you might get a different result.
That happened 2 weeks ago when we did.
So yeah. There's a retry button if you're not. This is why if you're going to use AI, you must insist that it gives you the original documentation. And if you've ever used AI in any way, you know that the results that come back might not be perfect. So sometimes you have to rerun these prompts a couple of times. Now, why is it in phase 5? That is because companies in phase 5 are returning capital to shareholders. Mm-hmm. When we built this prompt, you have to have dividing lines for this phase versus this phase. You can't make it squishy. So the dividing line that we have for phase 5 is, are you buying back stock or are you paying a dividend? That's phase 4 versus phase 5.
So Mr. Froldy, just real quick, because Jason asked a question asking if we would upload a video to go over how the AI prompt making process worked. And that's not like, we're not going to show how we made the prompts.
Yeah,
but
that
like,
took us 2 months.
Yeah, but to just kind of peel back the layer a second, it's one of those things where, like, I look at the Trade Desk and honestly, I say stage 4 because in my brain, I'm like, okay, I know that they bought back stock. So I realize that. To me, the bigger thing is operating profits are growing much faster than revenue over the last 2 years. Mm-hmm. So in my mind, I'm like, that's stage 4. But to make this AI prompt work, we have to give it rules, right?
We have to give it specific step-by-step instructions and rules. Yep.
So Scott says the buybacks are irrelevant relative to stock-based compensation. It's not accretive to shareholder equity. I don't think that Scott is wrong about this.
Yep.
I think what we're just really saying is this does a good job of giving you the ballpark of where to work, But like if I was doing this, I'd look at it assuming stage 4 and stage 5.
Yeah, I think so. So again, in Stock Simplifier, let's say we say stage 5. The reason we force you to do that is because the metrics that you analyze change, and the valuation metrics change depending on which phase that you're looking at.
Yeah.
But if you want to say stage 4 instead, and just run it on kind of both of them, there's no problem with doing that. There are some companies that are just on the line, and we have to make a call for this versus that, and that's why we asked ChatGPT to give you a confidence level as well. This was by far the hardest prompt to create, and it is the prompt that is the trickiest from an output perspective. So this prompt has been so hard to make. This is prompt version 18.7 of this one. So it has taken us so long to get this prompt to be the best that we can be. But even still, it's still not perfect. This is why AI is an awesome sidekick tool, but it is not a replacement for thought.
Yeah, exactly.
Cool.
Exactly.
Cool. All right. So it's in phase 5 for the sake of this this workshop. The next thing we have to do is, well, what does this company do? So in Stock Simplifier, we have a section here, and it's just red, yellow, green. I'm confused. I understand. I'm excited. Now, here are the questions that we teach you to ask about every company. 4 are just purely quantitative. What does the company do? Who are its customers? What are its key products and services? So the ones in black here are purely quantitative, easy to look up. The green ones are qualitative. How frequency do customers purchase? Is it recurring or a one-time? Can the company raise prices? What happens in a recession? So these are key questions that we think you have to ask about any company. So let's go ahead and run our prompt here. So here's our business analysis prompt. I'm going to go to ChatGPT.
This is my favorite one, by the way. I find this one the most useful.
Yep. So it should say, great, give me the ticker, the trade desk, TTD. Okay. Searching the web and coming back. Now, we've designed all these prompts to insist on SEC filings as sources. So here's the trade desk's 10K. There's so the trade desk is an okay source, and the filings are an okay source. So this is from the year ending 2024. There's also results from Q2 of 2025, but it mostly relied on the 10K. Okay, what does the company do? The trade desk operates a programmatic advertising platform, a demand-side platform, that allows advertisers, agencies, and related service providers to plan, buy, manage, optimize, and measure digital ad campaigns on multiple formats: display, CTV, auto, native, and devices. And there's the SEC filing that it got that information from. It does not arbitrate inventory.
Arbitrage.
And it provides a self-service toolkit so clients can transact directly with publishers and inventory sources.
I always get confused with the trade desk. Does that mean that it doesn't like take a spread on each one? It's more just like for everyone, there's just like a flat rate or something like that.
It's an ad buyer. So it helps you buy ads on the web. It doesn't sell ads. It's an ad buyer. So you can go to the trade desk and place your ad on like hundreds or thousands of different websites in one go. And in theory, the platform will optimize your ad placement for the best reach and the best maximization across all platforms. So it's kind of a one-stop shop, with the exception it does not work on Google and it does not work on Facebook. Those are
kind of important
walled gardens, if you will. So if you want to advertise off those platforms, this is your idea. And the idea is what you just said. It doesn't mark up the ad prices. It passes those along to consumers. So it's a friendlier model for advertisers.
Is it kind of like, could you say it's kind of like the Costco of programmatic advertising?
Let's go with the Costco of
okay, there we go.
Okay. How does the trade desk makes money? The trade desk primarily makes money via a platform fee.
So that'd be like the membership fee at Costco.
The percentage of a client's total spend, gross spend, on ads and value-added services on the platform. It also offers value-added services and data layers that clients may pay for, layered on top of the core ad functionality. So the more you spend on ads, the higher the fee that it takes. Okay, so revenue was 2.44 billion in 2024. In 2023, it was 1.946 billion.
That's a pretty good rate.
Love that this has the SEC filings right there. So you can be like, is this number accurate? Is this hallucinating? Right there to find out. Okay. The 10K does not break down subsegments in publicly tabulated form. The company core business is heavily weighted towards platform fees.
Okay.
Who are the customers? Advertising agencies and media buyers who use the platform to manage spend for their advertising clients. So
And
advertising agencies and big media buyers.
yeah, if I remember correctly, one of the things the trade desk did was instead of going directly to say like, I don't know, Campbell Soup or Clorox, they went to the agency that Campbell Soup or Clorox uses. And so if memory serves, there might be a little bit of concentration risk there.
So, well, we'll check that,
Yep.
obviously. But I think that if you're at the Clorox level, like a big company like that, they might have this capability in house, and they might be
Okay.
a
All right.
direct.
All right.
If you're a smaller company that uses an agency because you don't have that capability in house, that agency would use this. So
Okay.
I'm guessing the biggest of the big would
Do
buy
this on their own.
directly. Yeah,
Got it.
but it depends on the company, right?
Okay.
Direct advertisers or brands using the
There you
platform
go. That's what you
versus
just did.
agencies or in-house,
Mm-hmm.
and then service providers who partner with those agencies.
Mm-hmm.
The company also operates under master service agreements with clients, which suggests ongoing contractual relationships.
That's important.
Where does it revenue? The trade desk operates globally, although the 10K treats it as a single reportable segment. So it does not disclose.
Huh.
It discloses gross spend and revenue by geography. Note 12. Okay, according to CSI's market breakdown, US and Canada are for the mass majority. International forms the remainder, but growing. And it hit gross spend of 12 billion, up 25%.
Wow.
Yeah,
My
that's
guess
gross
is if
spend, not revenue, gross spend.
my guess is if you wanted to know what the exact breakdown was, you could click on one of those sources that were linked to above, and maybe not that one, but it was a little bit higher, and you might be able to find that
But
there.
at least here's the 10K. Here's
Yep.
the direct source of
Yep.
information. Because again, how else do you trust the AI analysis? Insist on the direct source of the information.
Yep.
Okay, so business dynamics. How often do customers buy? Purchases are typically ongoing and recurring. Clients transact monthly. The company invoices clients for ads, purchases made on the platform. Client retention is very high, 95%, which it has been for
Mhm.
many years. And because clients continuously run campaigns, the model is stickier and recurring rather than one off. Love
Mhm.
that.
Mhm.
Okay. Qualitative question 2. Can the trade desk raise prices? Well, the company's margins and profitability suggest room for leverage. In 2024, it achieved operating income and profitability, showing operating leverage is functional. So,
Mhm.
operating leverage is like sort of pricing power, but not
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 necessarily.
necessarily as much as gross profit would be. But anyway, the 10K noted that the take rate, revenue as a percentage of gross spend, may fluctuate and is subject to client feature choices and volume discounts, which suggests some flexibility in pricing.
I would
So
say take rate is a much better sign of pricing power.
I would say so too. But it does say with volume there is discounts on that, which does make sense. So
Oh, totally. But
yeah, the
yeah,
ability to raise fees depends on the value delivered and clients' relative sensitivity to costs. So can it raise prices? I'm going to go with, I wouldn't say no. I wouldn't say it has
I
extreme
think they're going to
pricing power.
lose.
Middle of the road.
Yeah, they could, but they might lose customers if they do.
Yep. And then what happens in a recession? Advertising spend is cyclical and
Yeah.
tends to be among the first discretionary budgets cut in downturns. The trade desk is exposed to macro ad budgets. Oh, for
Yeah.
sure. However, it has very high client retention rates and strong performance in prior cycles that may provide some buffer. The 10K includes risk factors about fluctuations in customer demand, macro activity sensitivity, and client budgets. Historically, the company has shown growth even in challenging environments, but growth may slow. So historically, it's grown even through recessions.
But it was off of a smaller base at that point in time, too.
Yep,
Bigger it
totally.
gets, the less likely that they're going to be able to do that.
And if advertising budgets cut sharply, growth spend fails, platform fee revenue would decline proportionally, reducing margins and weakening. All right, poll time. So now that we know about the business and some qualitative factors, what do you think? Is this an attractive business. So red, no. Yellow, it's okay. Green, definitely attractive. What do people think here?
Yep. So our folks watching on Zoom are putting in now. If you're watching on YouTube, feel free to just put in. What do you think? Is it attractive? Is it not attractive? Um, we've got a very close, uh, very close one here. I'll wait about 5 more seconds to get in some votes. All right. I'm going to end the poll. We got 2/3 of people responded. It was very close. 52% of the people said yellow, possibly.
Okay.
45% said green, absolutely. So yeah. Well, Brian, believe it or not, the biggest question that we've had so far has nothing to do with the trade desk. The biggest question we've had from people that have been coming in late, they said, how do I access that AI prompt? I got here late. Did I miss the
Got
AI
it.
prompt?
Got it. So all of the AA prompts we have are in our tool called Stock Simplifier. Stock Simplifier is normally $199, but for this webinar and this workshop, you can get it for $99. And if you want access to the course, to all of the AI prompts, to the tool, the spreadsheet, the graphics we've made, everything, $99. So if you could throw that in the chat,
Yep. So I'm
that would
throwing
be
it in the
great.
chat
If you
right
could
now.
throw that on the YouTube comments, that would be great. But the results we got say 52% say it's a yellow, 45% say green, 3% say I'm out, not interested at all. This is a stock that I've personally owned for about 5 years now, so I am firmly in the green category.
Mhm.
You do not own it, correct?
I do not. I have in the past, but it's that recession part makes me a little worried. I also have a tough time. We're going to talk about moats in a second. I have a tough time really understanding the moat, and that's more on me than anything else.
Okay. Well, I know for a fact that this company, since it came public, has had a client retention rate of more than 95% every single quarter for 8 years now.
I mean, that's
So
not bad. That's not
if
bad.
it's doing something correct,
Yep.
doing something correct. Okay. Next up is the moat. So there are three categories in Stock Simplifier of moat. Again, we made things simple. So moat is none or the moat's getting weaker,
Mm-hmm.
stable slash narrow, or wide slash expanding. So here are the 5 sources of moats: network effects, switching costs, low cost producer, intangible, counter positioning. And then there's 3 directions, none, three current statements, none, narrow, wide. And then there's direction, shrinking, stable, widening. Let's do a poll. What do you guys think? What is the trade desk's current largest moat source? Current
All right.
largest moat source. Which one do you think? Now, if you think it has multiple ones, which one do you think the primary moat that it benefits from?
And again, yep. So you have your choice. Is it network effects? Is it switching costs? What is it? And Brian, once folks vote on this, I want to get your. Is it okay? I'm going to ask you what your opinion is before we ask AI, just because I'm
Yep.
curious.
Yep. Sure thing.
Because again, this is one I'm not embarrassed to say there's some things that I just don't understand because I don't get it.
Hence why this is a from scratch. You're not
Yep.
supposed to know everything, right?
Yep.
Yeah. Cool. So slower voting on this one. So I think people
It's
are trying to
it's
think.
harder.
Yeah, definitely harder question. And wow, are there a variety of results here?
I know.
Uh,
I'm gonna wait just 5 more seconds. Got about 60% of people have responded. All right,
yep.
Brian, here's what people said. We have the winner was network effects. 32% of people said the more people that join, the stronger it becomes.
Yep.
Low cost production was 28%. Switching costs was 22%. And there was even votes for intangibles and counter positioning too. So, I mean, networks, low cost switching, those were the big 3 that got most of the votes.
Yep. So if I was to vote, I would personally say switching costs are number 1. The reason there is, again, that statistic, 95% client retention rate for 8+ years. I think once you get on this platform, you're going to have a hard time getting off. If I was forced to say a second one, this might surprise people. I would say counter positioning. And the reason I'm saying that is because I know the business a little bit better than you do.
Mm-hmm.
They have counter positioning against Google and Facebook, who are their 2 biggest adversaries, or Meta. Those are walled gardens. And some companies just don't want to have all of their advertising buckets in one business. They don't want it all with Google. They don't want it all with Meta. If you are Meta or Google, how could you possibly compete against the trade desk who offers open access to everything?
Right.
It would be a complete business model shift and change up for Google to try and compete with the trade desk. Moreover, the scale here is Google's at like what, like 300 billion in
Mm-hmm.
revenue? The trade desk is 2 billion in revenue. So this is like a pimple when compared to Google's gargantuan size. So I think that counter positioning provides Google, the trade desk, with a moat against the big guys, and I think switching costs provide it with the moat against all other
Ooh, I
competitors.
like that. That's helpful. Real quick, we got a couple questions coming in. Nart just basically echoed your point. Said, I thought the whole point of the trade desk is that it operates on the open internet as opposed to Google and Facebook. I
Boom,
agree.
boom. So
Real quick,
that would be counter positioning.
yep. Jess said, has it always been true that the platform does not work with Google and Facebook? I believe the answer is yes.
Yes. Yep.
And then just real quick, a couple people said, how long will they have updates to these prompts if they buy it? And will they have access to any updates that occur?
Yeah, the prompt is in a library, and if we make an update to the library, the AI is tricky because the LLMs are always changing. The prompt format's going to be changing. I mean, it seems like every week there's a new AI thing that comes out. The reason that we're making these prompts is because we plan on changing the prompts as the latest and greatest comes out, and that's why we're doing these live workshops, so we can show you the latest and greatest. So if you buy Stock Simplifier, you get access to the prompts, and as we update the prompts, you'll get access to the updates. It's a one-time fee. It's not a recurring fee. It's a one-time fee.
One more question and then we can move on. And it is about Amazon. Does Amazon's DSP, is that a direct competitor? Does it work with Amazon? Do you know? I'm not sure.
I do not know that.
Okay.
I do not know that. I would guess the answer is no. I would guess that Amazon is a walled garden. I don't think you can use the trade desk to buy ads on Amazon. It would be great if you could, but I do not know the answer to that. That's probably a good question, though, because Amazon is very rapidly becoming the number 3 there. But anyway, let's ask ChatGPT what it thinks the moat source is. And okay, so there's the moat. There's the moat prompt. Put it into ChatGPT.
For what it's worth, the internet says you cannot directly buy Amazon ads through the trade desk.
That would make sense to me.
Another walled garden.
Another walled garden. Yeah. So we're gonna go with trade desk TTD. So what moat source do we think this?
I'm very curious to see.
I am too. Okay, so this says the trade desk's moats. Its current moat is narrow.
Interesting. Okay.
I agree with that. Its current moat is stable. Its primary moat sort is the network effect and switching costs.
Okay.
Summary. The trade desk exhibits a defensible digital advertising platform moat rooted in network effects and high client stickiness. Morningstar recently upgraded its moat to narrow.
So it used to say no moat.
Right. So this prompt gives you an overview, and then it gives you a moat by moat analysis. So
let's read through that. This is
switching costs. It says, yes, it has switching costs. They're narrow and they're stable. Clients build integration, workflows, measurement pipelines, and optimization stops into the trade desk. Departing would involve significant migration costs, not just switching software, but starting from scratch.
Yeah, that makes sense.
Customer retention is 95%. Growing operating margin implies that clients remain sticky. And the quote, the platform approach allows the trade desk to scale revenue without proportional scaling costs, creating sticky relationships with clients. Now that's from Steady Compounding. So that's not a direct source. Anyway, intangibles. Yes, narrow and stable. The trade desk's brand in programmatic ad tech, reputation for transparency, and data optimization capabilities contribute intangible strength. While these assets are meaningful, they are not unassailable. New entrants or tech giants could replace branding and capabilities over time. So strong revenue growth, investments in R&D, and we assign to Trade Desk a Morningstar a high uncertainty rating. The expansion before demand-side platforms may introduce new risks. Network effects. They're present, they're narrow, and they are potentially widening.
Interesting.
As more advertisers use the platform, the trade desk gains richer data and stronger optimization feedback loops, which can result in better client results, reinforcing the appeal of the platform and increasing barriers to add it. That said, the effect is not infinite as competitive platforms. Google, Amazon, look at it. It lists Amazon.
There it is.
Compete heavily.
Hey,
So
can we just pause for 1 second on that? This
Yep.
is something, Brian, you and I, when AI first became a thing in 2022, when we were doing our original stocks from scratch, this was something that everybody said. Everybody said we have the network effect because we have data that makes our AI smarter and stronger than everyone else's. And by the end of all that, you and I said, everybody's saying that. Does this count? Is it real? I'm just curious what you think about that.
So this was the number one choice for our viewers. They said network effect. And I can see the platform getting better and better and better up to a certain point. But I don't think this is like pure network effects where literally every new advertiser makes it better for every existing
So diminishing
advertiser. Yeah,
returns.
I think it's like an S curve where it's like gets really, really good. And then the improvements are tiny. I'm guessing they're in the tiny improvements phase, but you know, maybe I'm wrong. Maybe it does get better for every single person. All right. Low cost assessment, low cost production, not present. It does not have scale there. And then finally, counter positioning. It says, no, the trade desk model is not one that incumbents can't copy without self-harm. In fact, major tech firms are direct competitors and are already emulate similar ad tech architectures. It's differentiated is more execution, data capabilities, and transparency rather than disruptive counterposition that incumbents cannot. So there to me is it the transparency thing. So I'm going to interpret this differently than ChatGPT did and say, I'm going to say transparency is counter positioning.
Right.
I'm going to say that is, but you know, maybe I'm wrong.
That's why I like to say that these prompts are like training wheels, but they're not, you can ride on your own.
Yep. So primary risks, the most significant risk is competitive pressure from the large platforms that can replicate or bundle similar services, which erodes differentiation. Morningstar also flags high uncertainty around expansion beyond the traditional display functionality. Incumbents and new entrants compete heavily both on pricing and performance. The trade desk must maintain advanced data measurements and transparency. Valuation risk, we're going to get that into that ahead, although Morningstar says the fair value is 82 for what it's worth. And then my analysis aligns with Morningstar. So anyway, okay. So I would say it has a moat. The moat looks stable, but the moat is not unassailable.
I agree with that.
Okay. Next, growth. Does this company have long-term growth potential? Now, let's show you the easy way to figure this out. So I'm going to open up fiscal.ai, and I'm going to pull up the trade desk. And this is just the 30,000 feet look. Analysts think that this company is going to grow its earnings per share by 20% over the long term.
Per year.
Per year on a compound annual growth rate. And revenue is expected to grow about 17%. So this company is expected to grow double digits. So that's the easy answer, okay? The more complicated answer is the story behind why should the company grow? There's two ways to grow. More customers, new customers, or get your existing customers to spend more. If you get new customers, that could require new distribution, new markets, acquisitions, or investing in sales and marketing. To get people to spend more, that could be raising prices, new products and services, and improving customer retention. So the prompt that we built for this long-term potential doesn't look up the growth rate. It looks up each of those subsources and says, is this part of the story for why you believe that the trade desk should grow? So I copied that prompt over. We're going to tell it to do the trade desk, TTD. And let's see, of those 7 sources of growth, which ones does ChatGPT think are the most likely to be a source of revenue growth for the trade desk, the source of profit growth for the trade desk moving forward? Okay, so using its most recent 10K and investor presentation.
I love the color coding.
Yeah, okay, so color coding, strong, moderate, weak, or not applicable. Okay, sales and marketing is moderate. The evidence is the company regularly increases go-to-market spend, okay, with medium confidence. New distribution channels, strong. The trade desk has been launching new access models like OpenPath, direct publisher yield paths, and Deal Desk to open up channels between advertisers and publishers. Confidence very high. Okay. Geographic expansion moderate. This 10K says international expansion is a key growth pillar and notes effort to build deep local sales and support presence. Acquisitions weak. The company does not emphasize acquisitions. I'm fine with that.
Yeah.
Existing customer expansion, pricing power. We kind of talked about this, and it says the take rate may adjust with value-adding services, suggesting some flexibility, and product enhances like Kokai aim to improve ROI on higher prices. Okay.
And we're about to find out more about Kokai.
Yeah, Kokai. New products and services. Recent additions, including Kokai, which is AI-driven decision-making. So I'm guessing it's AI buys the ads for you.
Yep.
Data integration and advanced measurements and direct paths are intended to boost attach rates. Very high confidence. And then customer retention, which we already know is strong. That's not going to really increase. It's hard to improve from 95%. So why should we believe it's going to grow? New innovations and Kokai with higher attach rates and new distribution channels. Secondary drivers are pricing power and geographic expansion. And then internal marketing and sales and acquisitions are not big opportunities. And then there's a little visual here that shows you color coding as well as the sources. So, all right, I think we have a poll here. What do you guys think? What is the trade desk's growth potential? Is it red, bad, yellow, okay, or green, great?
Well, we got a lot of quick answers on this one, which is great. And you know what, Brian, I'm going to stop it after just 20 seconds because we have such a clear winner.
Okay. What do people say?
So the top one was yellow. They said it is medium.
Medium.
Yeah, so they said it's good. It's good. It's not great.
Yeah. To me, 20% is great, but it's not hyperscaler or as great as this company used to be. So I would call it green personally. But you know, this is subjective. So people say yellow. That's fine. As a reminder, people in the chat that are asking, if you want Stock Simplifier, if you want all the AI tools and everything like that, there is a link in the chat, or there's a link on the YouTube in the notes section where you can buy Stock Simplifier, all the prompts, all the tools, all the visuals, everything for $99, and that's a one-time fee.
Two quick things real quick that people have questions about with that. Number one, I apologize for those on Zoom. The first couple times I posted it, it was just between Brian and I didn't do it to everyone. It is now in there. It's been in there.
I've done that myself many times. Yeah. But by default, it just sends it to like the hosts.
Yeah. So Brian, you know where to go if you want to sign up for the service that you created with me. The other question that a lot of people are asking, Brian, is do you need to have the paid Chat GPT in order to use this?
That's a good question. The answer should be no. I don't know what ChatGPT's current free plan limits are. I've been a paid user for a long time, so what you're seeing is the paid plan, but I don't think they rate limit anymore. Like I'm not a paid user of Grok. I'm not a paid user of Claude. I'm not a paid user of Gemini, and I've used these prompts on all of them. So it might be slower. It might be, we designed this so you shouldn't have to pay for anything extra if you don't want to.
Yeah, exactly.
Yeah. It also works with the free version of fiscal.ai. So if you don't want to pay for fiscal.ai to get the data, you don't have to. So it in and of itself uses free resources. I recommend paying for the premium version of fiscal.ai and the premium version of whatever AI you're using. I use ChatGPT, but you do not have to.
Yep.
Okay. Next, the key metrics. Now, as we said before, the key metrics that we're looking at and the way that we analyze them changes depending on which phase the company is in. So in the tool itself, we ask you to say which phase is it's in. So we have said this is in phase 5. And in the course, we teach you how to look up every single metric, why that metric is important, how to think about it, and more. But we're going to go ahead and use AI to look up these metrics for us, knowing full well that ChatGPT isn't always the best at math.
And we're going to use stage 5, right? But
yes,
if we're not going to do both for everybody here because we're not, I think we put the wrong prompt in there. Yeah.
Yes, I did.
we're not going to use both because we don't want to take up everybody's time. But if I was doing this, I would do this for phase 5 and for phase 4.
Yep. Okay, there we go. Oh, it's still running that old prompt. There we go. So for this prompt, you're going to do the name, the ticker, and the phase that it's in. So it's asking for the phase. So I'm going to the trade desk TTD phase 5, and we are going to see what the prompt says, or rather what the results say. Now, again, if you want the original source of this information, you go to fiscal.ai. This is all pulled directly from the SEC filings. This is very trustworthy data. These prompts are designed to be kind of a shortcut to getting there. Okay.
Brian, have you ever used the prompts in Fiscal AI? They're like LLM offering.
I have. They're good for screening and stuff like that. I haven't used these prompts in there, if that's what you're asking.
Yeah.
Yeah. Okay. So let's look at these for revenue growth on a 3-year basis. So the score is a yellow. So right now it's 26% compound annual growth, and the target is above 10%. So with some deceleration recently. So I would have checked this to be green, because 26% for a phase 5 company is pretty darn strong. So, but I think it's interpreting that based on the recent trend of the decelerating growth. Okay, next, free cash flow conversion rate. It's well over 90%. Free cash flow was $632 million versus operating profit of $427 million. So free cash flow conversion of over 90%. That's green. EBIT to interest expense, likely well above 5. The trade desk has basically no debt, so all good there. Return on invested capital, it says likely between 10% and 20% positive. What is fiscal data set? Return on invested capital is 16.8. So high, over 10%. That's a yellow. That's not like fantastic. And capital returns, yes, the company is repurchasing shares.
I'm not sure if that's right.
I don't think that's right either.
I don't think that's right.
It says it's been buying it back for more than 5 years. I don't think it's been buying back stock for 5 years. In fact, let me go check that real fast. If I go to...
Yeah, this might even be tough to show. Yeah, if you do the cash flow statement, you can find it.
Okay. So issuance of debt, nothing. Here we go. Issuance, repurchase of common stock. Okay, it was correct.
I think that they were offsetting a little bit. To me, that's just 2.5 years, but I get why it said that answer.
Well, technically, it has been repurchasing stock for more than 5 years. So
yes,
the AI was actually correct.
Yep.
It was actually correct there. So financially, this company's strengths are its free cash flow conversion and its capital returns. Its slowing revenue growth is a concern, and the ROIC is not as high as you would like. And then finally, a critical point to watch is whether revenue growth remains robust. So I would give it a mixed green and yellow grade here. Nothing that is crazy concerning. For the sake of time here, I'm just going to skip forward. We're not going to do questions, and we'll just finish these last two. Okay, so next is risks. In Stock Simplifier, we teach you all risk boils down to one risk: execution risk.
Yep.
Can the company do what it says it wants to do, and what could prevent that from happening? That is execution risk, and it's the only true risk that matters. Now, within execution risk, there are several important sub-risks: concentration risk, disruption risk, outside forces risk, and competition risk. So we're going to boil all of these together and come up with one overall assessment for the riskiness of this business. So I have the risk analysis here. I'm going to paste this into ChatGPT. And let's see what the overall riskiness, the overall execution riskiness to the trade desk is, according to AI here. Okay, trade desk.
So Brian, while it comes up with that, quick question from Dominic: is it helpful to run these prompts after every quarterly report, or best just when you're getting started?
All of these prompts are designed for when you're first getting started. Because again, we're trying to figure out what the company does, what's its moat, what are the key metrics to track. This is an overall assessment. After you know the company, The ongoing prompts that you need to kind of track progress is a different set of analysis that you need to do, and you really need to figure out, is the thesis on track?
Yeah.
Right? Have any of the things that I said last time, have they been updated or changed substantially about the company? We actually haven't built those prompts yet.
Well, and
So
for what it's worth, I think it's okay for you not to have a prompt for that, because I think your understanding of the company after this is like the dip your toe in the pool part is going to be unique to the type of investor you are.
yeah. Okay, that took a while. Come on. There we go. Execution risk is medium. The primary risks are competition and outside forces. The key mitigation risks are client retention, diversified platforms, and very low levels of debt. It says moderate. I'm pretty sure the company is very low with debt. Okay, so taking the risks one at a time. Concentration risk is a yellow flag. The 10K highlights the loss of advertising agencies. Holding companies could significantly harm our business. There's no customer that's more than 20% of revenue, though.
I thought they were supposed to disclose if it was more than 10, but okay.
It says 20. But you are correct. They're supposed to disclose if it's more than 10. So it does say that's a moderate risk. It's not a huge risk, but it is a moderate risk. Disruption risk. There are rapid shifts in identifying advertising advisements, the loss of third-party cookies, regulatory pressure on tracking and privacy are problems, and emerging AI or machine learning platforms might internalize decision-making rather than relying on a company like the trade desks.
Now, just to add a little bit of color here, because I went into the actual source site to show the difference, like what is AI good at, what is it not yet perfect at. The top 3 clients account for 42% of accounts receivable. So, I mean, there are 3 big clients there.
But
none are over 20.
Is that accounts receivable?
That's accounts receivable. So I know that's not the same as revenue, but just putting that out there.
Yep. So technically the AI did its job.
Yep.
But yeah, there is more nuance there. And receivables are not revenue, but it is absolutely worth knowing. So some client has extremely generous payment terms.
Yep.
And is taking full advantage of. Outside forces, red. Regulatory and privacy laws are a problem, and macro advertisement spending cyclicality. So as goes the market, as goes the economy, goes this company's revenue. And then finally, competition. The 10K states that loss of agencies or advertisers is a key risk, and intense competition from Google, Meta, and Amazon are with scale. So overall here, yellow, yellow, red, red. We do know that the company's moat does provide some defensive positioning. So let's do a poll here, Stoffel. What do you guys think of the company's execution risk? Red, it's very high. Yellow, it's moderate. Green, it's very low.
All right. Again, we've got a very clear winner. So I'm going to, and actually we got 60% of people responding. Our winner is yellow. The risk level is medium. Bruce says not a simple business to follow. I agree. It's complicated.
Totally agree. I totally agree with yellow, by the way. I would also mark it as yellow. This is definitely not a low risk business, given the things that are happening. I don't think it's the crazy highest red risk, given the company's history of execution, but it's definitely not low risk execution. As a reminder to everyone that's joining us here, if you want to get access to Stock Simplifier, we are running a 50% off promotion for everyone that's watching the webinar. Stoffel will share the link correctly in the chat.
In there right now.
And on Google. Okay, next, valuation. So the reason that we asked you to pick the business growth cycle in phase 1 is because the valuation metric that you should look at changes depending on which stage the company is in. Here are the 6 stages and the primary valuation multiple that you should look at. Now, this is a stage 5 company, stage 5, potentially stage 4. So the metrics that we're going to look at was already told for us in the very first AI prompt that we did. price to earnings and price to free cash flow. And for the sake of completion, we'll also do the forward numbers there, which are in phase 4. Now, to do this, we're going to use fiscal.ai. Fiscal.ai. So I have the trade desk pulled up in fiscal.ai. I click on financials, and then I click on ratios. I'm going to zoom in a little bit. It looks like it's a little small.
There you go.
Okay. So right at the top here is trailing valuation numbers. We're going to start with price to earnings, P to E. Now, here's the chart you see when you see PE. This part right here is useless.
Yep.
Utterly useless to us. So it's just going to throw off our calculation. So I'm going to go down to the slider, and I'm going to slide this to exclude that period when it went kind of haywired. So that looks like it's like 2023.
So it's going to be a short, it's not a super long history. Yep.
So here's the chart of the PE ratio over the last, call it, year and a half.
Yeah.
And to help us figure that out, I'm going to do some grid lines. So the average PE ratio is 190, and it's currently 58.
Mr. Feroldi, this is another notch in the, I think this is more stage 4 than stage 5.
Fair enough. Okay, but let's look at price to free cash flow. Let's do that same analysis on the other metric, which is price to free cash flow. I'm going to hide PE, and I'm going to focus just on free cash flow.
You could see if that could go back further too, because it might be able to, or it might not.
Yep. Yeah. I mean, it did get up to 130 times price to free cash flow in December of 2024. So the average price to free cash flow ratio over the last 4 years has been 64, currently 31. Looks like the absolute low was 28.
So it's pretty close to its absolute low.
A week or two ago. Yeah, I bet if we go all time, the all-time low was 15. Wow. In 2017, this company was trading at 15 times free cash flow, currently about 30. But as you can see, it hasn't been this low since 2018. All right, so those are the trailing numbers. Now I'm going to go to the forward numbers. Forward price to earnings, and we're going to do that same analysis. So this is the number to look at if it's in phase 4.
This is much more useful to me because they're not some crazy things in there.
Definitely. So, okay, let's put some bands on this for the graph lines, low, medium, high. And the average is 54 times next year's earnings, currently 25 times, 26 times next year's earnings on a forward basis. And let's do that same thing for free cash flow. Forward price to free cash flow.
Pretty close.
Does it mimic it? Let's do low, medium, high. And this company trades at an average of 53 times forward cash flow, currently 26 times free cash flow. So let's do a poll. What do you guys think? What do you think of the trade desk's valuation right now today? Red, it's overpriced. Yellow, it's fairly valued. Green, it's cheap.
I would say it's getting a little closer, but to me, all this goes back to my not understanding the moat. Because if I understand the moat and I'm like, hey, I get it, then I'm like, green. But if I'm like, that moat, I'm not quite so sure about it, then I'm like, yellow, red.
Yep, fair enough.
That's just me. Here's what everybody said. We have 49% said green and 42% said yellow. So I get it. I totally get it.
There you go. So despite everything we just talked about, on a valuation basis, this stock is, more people say it's cheap. I would be in the yellowish green. I would be right between these two. I think it's on the cheaper side historically, but if the growth rate is about to slow out substantially, or if there's major competitive threats on the market with AI and Amazon, if this company's growth rate slows substantially and stays low, as we both know, that is the death nail for growth stocks like this.
Yep.
Yeah. All right. So final one. Are you interested? What do you think of this stock? No, red, I'm not interested at all. Yellow, yes, maybe. Maybe I'll put it on my watch list. Green, definitely interested. You want this in your portfolio or you want this on your watch list. What do people think here?
Yeah. And while people are voting, Dawn on YouTube asked a great question. If I was using my anti-fragile scale, what would it get? I'm not sure, Dawn, but you've heard me say this many times. I'm not 100% sure what score I would give the moat and what part of my scale is the most important. What part of that? The moat is. So this would be a tough one. And Brian, we've got 70% of people have responded. Uh, Pretty much half said yellow,
Okay.
maybe, not sure. 32% said, yeah, I'm attracted. And almost 20% said, no, I'm not attracted.
There you go. Well, that's why we do this, so that you can figure this out for yourself. And there is no right or wrong answer to that
Mm-hmm.
question. There's just the right or wrong answer to you. Do we have any questions in general about anything that we did, Stoffel, that we can get to?
Yeah, you bet we do. So let's start out with Hengamet was asking, do we own the trade desk? I don't.
I do.
Okay, so that's one. VH.
By the way, the Trade Desk is the worst performing S&P 500 company this year.
Yep. Patrick says valuations are great, but we both have taught about value traps before. Do we think that this is a value trap due to the share price? Patrick, I'm going to sound like a robot here, but if that moat is under attack and not as wide as people think, it is absolutely a value trap. If that moat, if it can keep customers there, then I think the valuation is probably pretty good. I don't know the answer, which is why I'm saying pass.
Yep. So it depends heavily on what you think revenue is about to do. Do you
Mhm.
think revenue is about to grow and potentially even accelerate given their AI product, and you think client retention is going to remain strong?
Mhm.
If this is the kind of company that, like, just like when Palantir was trading at $6 a share, if revenue growth reaccelerates, this
Oh.
company could be a massive outperformer.
Mm-hmm.
If revenue growth is in a permanent state of decline where the growth rate goes to single digits, just like Zoom, for example, like
Mm-hmm.
Zoom's revenue has not come anywhere close to double digit revenue the last I saw it. And that company has been essentially dead money for
I think
five
their
years.
enterprise revenue retention fell under 100%.
So that company's been dead money for 5 years. It's still a very profitable business, great leadership, great everything. But growth stocks like this, they live and die by revenue growth rate. So to me, it totally depends on the answer to that question is what's revenue growth going to do? Reaccelerate, this is a very strong buy. Stay flat or decline, it might even still be overvalued. And it could definitely be a value trap if you think revenue is going to decline from here. So you have to have a good sense. That to me is what you're betting on if you're buying the stock today. You're betting on the direction of revenue growth.
So David said, and I'm gonna give my answer to David's question, then I'm curious about yours. David asks, I wonder if you have stocks in your portfolio that you keep long term, but they don't necessarily correspond to a buy using this tool, like what effect would that have? So, David, I am comfortable with that. The reason I'm comfortable with that is again because I believe that these AI prompts and Stock Simplifier in general is a great way to do what we've called it stocks from scratch. And so, if it's in my portfolio, so I am never going to buy a stock solely based on these prompts, but I am going to use these prompts to accelerate my learning. That's the key. It's not making decisions for me, it's accelerating my learning. So if it's in my portfolio and it doesn't get a great rating, I will consider why it might not have gotten a great rating,
Mm-hmm.
but my own due diligence matters more to me.
Yeah, and to be clear, with Stock Simplifier, we first built it as a course and a tool, and the whole point of the course is to teach you to do this manually. You
Mm-hmm.
need to know how to do this manually so that you can have confidence internally that these works and how to look this up. If you see, for example, return on invested capital is 15%, and you don't know what return on invested capital means, that's not going to do you any good. Buying a stock based solely on information you don't understand doesn't really help you. You need to develop the conviction internally for what these metrics mean and what they matter. So if you don't know what the metrics we've just covered mean or how to look them up, that's what the course is designed to do. But AI can assist you in accelerating the process. It does not replace the process.
Real quick, so I want to make a trade desk question or comment, and then a stock simplifier. Trade Desk, Ken said, coming from working for a large marketing agency, I don't believe I'm excited about this stock because many agencies are adopting AI and they believe that an in-house solution is going to catch up. And I think that is that plus the walled gardens getting more a percentage of traffic. I think those are the two big things that combine. And again, that goes down to that whole moat question. Does the trade desk have something that you can't get anywhere else?
Yep.
That's the question.
Fair enough. And I think that you could say that about software in general, like all software that's out there, right? So many people can develop the tools to do this internally. And right now, that's a major fear that I think a lot of that Wall Street has with stocks like this. My hunch is that the fear of that happening is going to overshoot the actual results. Like companies don't want to become their own software engineers. They don't want to have to, and anybody can use an AI prompt to build like a tool, but actually getting that tool to run and operate and maintain it and make sure it does the right things, like ChatGPT hallucinates. All the things hallucinate. And if you're building these tools yourself and you don't have the capabilities to maintain them and grow them over time, to me you're exchanging money for a platform that works for future time you're going to have to spend fixing problems that arise. But
So, Brian, a bunch of people, Munir, Jason, a whole bunch of people have asked, what is included in the package if they buy Stock Simplifier? Can you review that for us?
Yep. So Stock Simplifier is a couple of things. It's a self-paced course. So it's the course, and it comes with slides. It comes with the transcripts. It comes with the checklist that we use. It comes with essentially this checklist right here. It comes with the AI prompts to speed it up. It comes with definition of terms, everything. It comes with this checklist tool that you use to figure out which phase of the business growth cycle is the company in, what key metrics should you look at, and it comes with our database of AI prompts. And we're going to keep this database up to date with what AI prompts that we have. It also has a 30-day money-back guarantee on it. So if you buy it, and it's a one-time fee. It's a one-time fee. If you buy it and you use it and you don't like it, you have 30 days to decide if you want to keep it. And as a reminder, it's $99 while this workshop is going on. So Stoffel, if you could share that again in the chat,
Yep.
the link for that, it's $99 bucks.
And just a lot of questions about updates to the prompt. So Brian, just to be clear, if you get Stock Simplifier, it's not necessarily something you download. When you get it and you click on something, it'll bring you to a Google Sheets page. And when you click on the AI prompts on the Google Sheets page, it brings you to a library. We maintain that library and we will update the prompts as we go along. So every time, say 3 months from now, you want to research a new microcap stock, or you want to look at Tesla now that the cyber cab is doing well. So when you go there, if we've updated it and you just click copy and you paste it into Gemini or you paste it in ChatGPT, that will be the most up-to-date version no matter when you bought it, correct?
Correct. So in the course itself, it comes with the prompts that you just saw. And there's also videos that explain what the prompts are and how to use them and everything like that. That is a static, fixed in time thing. The reason that we also are doing these live workshops in addition to that is we want you to be able to utilize the latest and greatest that we find with AI and stock analysis. These prompts are going to change. The platforms are going to change. They're going to incorporate things. They're going to take out things. As those changes happen, as we figure this out, we're going to do more live workshops just like this, and we're going to share what we have learned since the last time that we do it. But the prompts that you get in the library, we will be, as we update the process ourselves, we will be updating it in there.
Mm-hmm. Exactly.
Hopefully that's clear.
And then one last question, Brian, what the heck do these numbers mean?
That is when I turn 65.
That's when I turn 65. Why do we have that?
It's a reminder to think long term.
Yep.
The most important question to ask yourself before you make any investment.
Yep.
When do I need this investment to pay off?
Yep.
That is when I need my investments that I'm making today to pay off. So it's a reminder, what happens next quarter or next month or the next earnings report, or is the market temporarily overvalued? That really doesn't matter if this is my target date that I'm going for. So a really important question to ask yourself before you buy any investment. When do I need this to pay off?
Mm-hmm.
And if the answer is less than 3 years from now, shouldn't be in equities, in my opinion.
Yep. One last question from Michael. Michael bought Stock Simplifier from us before we had these prompts, Brian. Does he have access to those prompts?
Yep, you do. Yep. You just log into Stock Simplifier, and the instructions are right in there. If you download the latest version of the spreadsheet tool, there's things in there. I also sent everyone an email that purchased it with instructions for how to do that. So, yep. As Stock Simplifier improves, if you've already purchased it, you get it.
Yep. That is all the questions that have come in.
Cool. And I see that it's also is at least working on YouTube. So we did an experiment today of live streaming to YouTube, and for at least it worked. And we know
it worked.
We know that
we had at least 2 commenters, ABB and Dawn, who participated via the chat a whole bunch.
Cool. So thank you guys so much for joining us. Our next live workshop will be in 3 weeks on Tuesday, October 21st. Everybody that's on our newsletter, Long-Term Mindset newsletter, will get I'll get a poll the Wednesday before saying, what stock would you like us to research live? And we're happy to research whatever stock interests people next live. And if we have any updates to our prompts, we're happy to walk through them. Who is that? Manuel says, what am I personally doing with Trade Desk? To me, the Trade Desk is a hold. It is less than 1% of my personal portfolio. So it is not a major risk, not a major position for me, but it's been a long-term winner for me, and I'm willing to stick with it. Although I do recognize that it might be dead money.
Cool.
Yeah. So I do not think this is a screaming buy personally.
But you're not selling either.
I wouldn't sell it. But again, it all depends.
That's
on
great context, though.
What do you think of? What do you think is going to happen to revenue moving forward?
Yeah, that's everything, right? Well, thank you everyone for the kind words, first of all, but second of all, you gave us an hour of your time, and we don't take that lightly. We really appreciate it.
That's right. So hope this session was useful, and we'll see you in the next one.
Hey,
Brian,
you got to do it now. We're on YouTube.
I just did. Yeah. Brian's out.